Hi, I'm Scott Olson, co-founder of LTCshop.com and author of Long-Term Care Insurance Now. This year, 2026, we're sharing 26 client profiles. These are not hypothetical examples. These are real people, real clients, real policies, real premiums, and real expert advice. I'll explain why I recommended one policy versus another and how we came to that decision. A common misunderstanding about long-term care insurance today is that the policies only cover a short period of care. I've seen posts on social media where people say, long-term care insurance only pays for 3 years of care, then you're out of luck. Now, do some people buy only 3 years of benefits? Yes, some people do. But if you're very healthy when you apply for a policy, you can buy more than just 2 years or more than just 3 years of benefits. Most of my married clients buy policies with 10 years of shared benefits or even 16 years of shared benefits. That's coverage that can help protect against a truly catastrophic long-term care experience. But there are even policies with no lifetime cap, an unlimited amount of long-term care benefits. In the past 2 episodes, we've talked about clients of mine who recently purchased long-term care insurance policies with no lifetime cap, no lifetime limit. In this episode, we're going to talk about one of my clients, Drew. She recently purchased long-term care coverage with no lifetime cap and no ongoing premiums. She simply moved one of her assets from one place to another. Now, Drew is 76 years old. She is a successful business owner. She has a very comfortable 7-figure net worth. And it's very important to her to protect her assets for her grandchildren. Very important. But most of her net worth is tied up in real estate. Now, her financial advisor suggested that she get some type of long-term care insurance because if she were to sell her real estate to pay for future long-term care expenses, the capital gains taxes would be huge. Her state taxes capital gains as ordinary income. She would have to pay hundreds of thousands of dollars in state and federal tax if she were to sell her real estate. She wants that money to go to her grandkids, not the government. And her financial advisor explained to her that if her grandchildren inherit her real estate, there will be little or no capital gains taxes owed. Her financial advisor showed her a long-term care annuity that would pay long-term care benefits for up to 6 years. Basically, the way it worked is the money she put into the annuity would go towards the costs of her first 24 months of care. And starting with the 25th month, it would pay benefits for another 4 years and then stop. She didn't like that it had a cap. She wanted long-term care benefits that would never stop, no matter how long she might need care. Now, why did she want long-term care benefits with no caps? Well, it's because one of the businesses she had owned for years was a nursing home. She saw firsthand how many of the residents in her nursing home needed care for 8 years, 9 years, 10 years, even more, some much longer than that. Should everyone buy a long-term care policy with no lifetime cap? No, of course not. My policy has a cap. My wife and I share 10 years of benefits. But some people, like Drew, really want long-term care benefits that have no lifetime cap. That's what she wanted, and that's what we got her. Now, long-term care policies with no lifetime cap are available for sale in 49 states. Sorry, New York, not you. Because of Drew's desire to protect her assets for her grandchildren and her experience as an owner of a nursing home, seeing firsthand people who needed care for many, many years, she bought a long-term care annuity that I showed her with no cap on the long-term care benefits. Plus, and this is important, guaranteed growth in the monthly benefit year after year after year. Now, she decided to use a $100,000 CD that she had that was earning a modest amount of interest, and she transferred that into an annuity with a long-term care rider with no annual premiums. She could have chosen to pay annual premiums for the long-term care rider, but she wanted it fully paid up from day one. Fully paid up. She likes to save up for things and then pay them in full. That's how she operates. That's how she rolls. And it's been working for her. Now, she does live in a high cost of living area. Because of that, she plans on buying another annuity next year and another long-term care annuity. If she never needs care and just dies suddenly, her heirs will get back no less than 70% of what she put into it. However, depending upon what happens with interest rates, if she never needs care, her heirs could get back all of what she put into it, plus a little interest. She likes the fact that her heirs can get back most, possibly all, of the annuity if she never needs care. But the main reason she likes this product is for the insurance benefits that have no lifetime cap. Now, if she starts to need care, let's say 10 years from now, she's guaranteed a monthly benefit of no less than $3,900, possibly as high as $4,400, depending upon interest rates. That's no less than $46,000 per year, possibly as much as $53,000 per year, tax-free income for long-term care. But it's even better than that because the monthly benefit keeps growing every year, even while she's on claim receiving benefits from the policy. That monthly benefit goes up every policy anniversary. And that's why she's going to buy another one next year and another one the year after that. By stacking the annuities like that, she can activate them at different times as each one is needed, depending upon how much care is costing. Is this annuity with a long-term care rider a good investment? No, it's not a good investment because it's not an investment. It's an insurance policy to help protect her other investments from a catastrophic long-term care experience. And if she never needs care, her beneficiaries get back most, possibly all, of what she put into it with a little bit of interest. What about her health? Are most 76-year-olds healthy enough to qualify for something like this? She had a few modest health issues, mild. She had sleep apnea. She was a little overweight. A couple of other minor health issues. But the underwriting for one of these annuities with a long-term care rider is very lenient because there's less risk to the insurance company. With an annuity like this, with a long-term care rider, the money you put into the annuity is used to pay for the first 24 months of care. So the insurance company does not incur any losses until after the 24th month of care. Because of that, the underwriting is very lenient. There's only about 5 or 6 health questions. That's it. Now, there are a lot of annuities, a lot of different kinds of annuities that are sold as a solution for long-term care. And a lot of them are not so good. If you've been given information about buying an annuity for long-term care planning purposes, please reach out to me and let me review it for you at no cost. In the next episode, we're going to talk about a couple, Steve and Marilyn. They turned taxable gains in a life insurance policy into tax-free long-term care benefits with no lifetime cap.